Just start off on this whole idea. We saw the numbers, and there is obviously concern of a so-called slowdown. What are you seeing in the business?
Hey, David, good to be with you. So look, interest rates have gone up at a record pace since the start of the year. So I think it's no surprise that marketers would be cautious in this kind of an environment and adjust their ad spend accordingly. But first, I think it's important to keep in mind ad spend is still growing, particularly digital. Typically what we've seen in times of prior economic stress is that brands lean in and they use this as a market share growth opportunity. They increase investment in order to come out stronger. And why not when ad prices may actually be cheaper when others are pulling back? And then second, there's usually a lag between consumer behavior and ad spend. Behaviors have shifted quite a bit during the pandemic towards video consumption, streaming, online commerce, and ad spend can take a while to catch up. But stressful economic environments typically accelerate the long-term change because advertisers are forced to think outside of the box. And to that point, I think walled gardens or social media are likely part of the past, not the future.
Explain what you mean by that.
Yeah, so there's a clear trend of advertisers moving towards the open internet and away from walled gardens. And just briefly, in terms of definitions, open internet refers to publishers or media companies like CNBC or News Corp or the NFL. And these are the types of publishers that we work with, and they create the wonderful professional content that consumers love. And they use open standards for buying and selling ad inventory. In contrast, we have the walled gardens, and these are closed or proprietary platforms. Many social media companies operate walled gardens, like a Meta or a Snapchat or a Twitter. And so there's a couple of drivers of the shift away from walled gardens. Walled gardens tend to be mobile app heavy, and there are known challenges with Apple's app tracking transparency framework. The content is often user generated, and advertisers don't like that. The open internet has professionally created content, which advertisers prefer. Third, video and CTV growth is driving increased usage of the open internet, and advertisers are falling with their budgets. And then lastly, consumers, I think, are increasingly aware of the toxic nature of social media. The Facebook files and associated revelations, Francis Hogan, all of that makes an impact. And advertisers just don't want to be associated with that. In fact,
that's interesting.
One of the world's... Yeah, go ahead. Sorry.
No, I was going to say, just in terms of like the calculus, how advertisers think in an environment of softening demand, we've heard this from some companies like P&G, there is an effort to at least keep advertising stable so you can start stealing some share. And I wonder if you think that's why we haven't really heard warnings from the agencies per se about softening demand.
Yeah, I think that's certainly part of it. And we saw this, again, in the pandemic just a couple of years ago, where the stronger brands in a category would use a slowdown, use a shift in the economic environment to actually assert their brand power, their leverage, and their balance sheet and gain share from rivals. If you think about automotive industry, quick dining, et cetera, these are opportunities to get a couple percentage share, market share gain that might otherwise take, 3, 5, 7 years. I think the other dynamic at play with the agencies is that there's always a shift towards digital in these times of economic stress. And so within an agency, there's probably a portfolio of some budgets that are non-digital and some are digital. And so they're able to help their clients shift towards more digital ad spend.
Rajeev, appreciate your time and your thoughts. Thank you.
Thank you, David.